Hello, everyone, and welcome again to another episode of the Reinsurance Podcast. I am your co-host, Jerad Lee.
And hello, everybody. I'm Ben Rose. And it's not just us two today. We have a special guest.
We do.
Who's our special guest today, Jerad?
We have an insurance partner from BCG.
Jacob Palmer.
Dun, dun, dun. Welcome,
Hello, everyone.
sir.
Hello, thank you for having me. It's really good to be here.
Welcome to the studio. You've had your initial tour of our secret location from where we record these. But really happy to have you on the show, in particular because of the interest you and your team have shown to the reinsurance industry recently. Admittedly, within a much broader context of tons of work you're doing, but maybe just to give the audience a bit of a flavour of what that report is about and where reinsurance comes into it. Could you just give us a quick summary?
Sure, happy to. So reinsurance is a really important sector for BCG within our insurance practice. We actually have a dedicated team focusing on reinsurance, which I think sets it apart a little bit, and it's made up of industry practitioners who really understand the space. I think that's where we're able to really provide a different perspective. Every year we produce what we call the Value Creators Report. So this isn't just within insurance. This is a report that BCG produces globally across all sectors, all lines of business. And really it's there to provide a view on how investors should think about different industries. So really to break down the economics of how industries are performing, both within a 5 and a 10-year horizon. So really to get different long-term, short, medium-term views, but also to really understand, where there is outperformance across different sectors across the market. Within insurance, we take those numbers and then we break it down by different parts of the insurance space. So we have a separate report for the reinsurers, one focused on life and health, one focused more on the P&C side. The reinsurance one is really interesting. And I think in particular, the results this year really stood out, really showing how reinsurers are actually slightly moving apart from the rest of the insurance space in terms of performance. Happy to go into some of the details. But it's really interesting to see the dynamics between outperformance across both the insurance space and the reinsurance space, and where some of those differences are. And that's really what the report tries to unpick and provide a bit of a more granular level of insight there.
I'm really excited to tuck into that with you, but I guess before we do, just so the audience know who we're talking to, how did you find yourself in this world of reinsurance consulting?
Yeah, it's a good question. So I've always been within insurance in some form or another. So I started my career actually as a pensions actuary. So coming out of university with a maths degree, it was, well, where should I go? What are the options available? And I didn't want to be a teacher or an accountant. So
it's funny you say that. So my brother actually became a pensions actuary and is now a teacher.
Interesting.
It was the other route he could have taken.
So I started in the pension space with a company called Hyman's Robertson. That was really where I got my grounding in core actuarial techniques. I quickly migrated more to the risk modeling side. I actually moved into the banking space within Hyman, so doing enterprise risk modeling, so looking at credit risk, market risk modeling, really, much more quantitative, numeric. For me, it was really about taking those core actuarial skills and applying them to a different sector. That though gave me my taste for consulting. It gave me a taste of moving beyond talking to trustees of pension schemes to working for a wider variety of companies. I spent a little bit of time at EY in their Solvency II capital optimization team. So that was where I really got insurance fundamentals. So how an insurance company works, how the balance sheet dynamics operate. And then was lucky to move to BCG, where I kind of took that core knowledge and applied it in a much more strategic context. Left BCG actually originally in 2020. So that was my first stint there. Spent a year at Cybercube. I was director of consulting there. So that was my immersion into the more commercial and cyberspace. And then I also spent some time as strategy lead for the reinsurance line of business at Swiss Re. So I've come through various different twists and turns within the insurance space. Probably still trying to find my home there. But reinsurance is the one that's really grabbed me and where I'm going to be spending a lot of my time going forward.
I mean, the reinsurance space, everyone has a different journey into it. Yours is much better than the either by accident or my dad does this sort of route. But it's one that I agree with you. Your last point is, I think, really poignant, because once people sort of fall into this space, we've talked about this numerous times on the show, like, it's so interesting. There's so much to unpack, and we'll dive into the report as well. But you look at the broader insurance sector, and then you dive into the reinsurance element of it, and it's so unique and so interesting that it sort of draws you in to sort of unpick it more and more and more. So it's a super interesting journey, and I can see the appeal to stick around in this part of the industry for a while.
And I'm also deeply reassured by the numbers in that report now, knowing all
Yeah,
the
exactly.
actuarial credentials.
The
and-
confidence
Yeah.
in the
If you were there doing, I don't know, presumably all the Solvency II internal model applications and things as well, it's a pretty tough training.
It's tough training. Yeah, we perhaps don't go quite that deep within
Yeah.
the report, but yeah, it definitely helps understand how the different dynamics work.
Yeah, brilliant. So one thing I wanted to get the conversation started about this report with was, I think, quite a noticeable change, at least for me, that seemed to have taken place when you look at the 10-year
Yeah.
horizon versus the 5-year. Could you just elaborate on what that change is and maybe some of the drivers of it from your perspective?
Sure, happy to do that. So the way we look at total shareholder return or TSR within the report is by breaking it down to three core components. So if you think about how an investor will make money from a firm, it's they get cash back, so they can either they receive dividends, or there's some kind of share buyback to return cash, and then there's capital gains. So they make capital through, and the way we look at it is by breaking down capital into two components. There's a component which is what is the growth in the tangible book value of that company over time, so the equity component, and then there is what is the market perception of that company, what is the price to tangible book value multiple, and how has that grown over time. So broadly speaking, for us, that's a proxy to understand, the growth of $1 of investment in a company over time and how that breaks down to the core components. If you look at the 10-year view, reinsurers massively outperformed the rest of the industry.
Good news.
That was good news.
Yeah.
So
sense a but
there's always
coming.
but. So look,
Yeah.
clearly, partially this is just luck of timing to a certain
Yeah.
degree, is when you start your 10 and 5-year horizon. But ultimately, over that time period, although there were some major losses, there were also some really benign years as well. So 2013 to 2016 in particular were considered relatively light years from a nat cat perspective. So that allowed reinsurers to grow, and I think that we see that across all of those three elements, across both how the market perceived reinsurers, the amount they were able to then give back to their investors, and then the growth in their own tangible book value as well. Clearly, the 5-year window has been very different. We've had extreme losses over the last 5 years. We've clearly had Hurricane Ian over the last few weeks as well, which will clearly impact results going forward. But we start to see a change in the picture here. For me, the most interesting change is not just the headline number. So the headline number, yes, is lower for reinsurers than it is for across the P&C space. But for me, it's that all of the value that reinsurers have gained on average has been from either share buybacks or dividends, or through the change in the multiple. That's really where that value has come from. Actually, the tangible book value growth has dropped for reinsurers compared to the rest of the market, and that's a unique facet of reinsurers over the last few years, given the losses that have accumulated across the space. So despite those losses, the market sentiment is still quite strong. There is still this belief that reinsurers can, over the long term, outperform and deliver value to their shareholders. But if you look at it from a purely fundamental economic perspective, there has been value erosion to a certain degree in reinsurance over the last 5 years, and there's only 2 or 3 of the players that have really been able to buck that trend and to really stand out and continue to deliver constant returns to their investors. So for me, that's the big story. It's we've clearly had a very volatile period of time, but something has to change in the dynamic for reinsurers to start to reassure their investors that there's a continued long-term value creation story from their books.
Yeah. We spoke about in an earlier episode the sort of ways reinsurers make money. And we talked about sort of the investment income being one of those. When you looked at the few firms that were able to buck that sort of downwards trend over the last 5 years, what were the drivers of their ability to do that? What were the sort of the learnings from the firms that sort of outperformed?
Yeah, so I would say there are two elements. So one, exactly as you mentioned, is investment income. I think that has been the predominant driver of profitability across the reinsurance space if you look at it across companies. The other element for me that really stood out was actually on the multiple side. So the ability to communicate what your results are going to be to the market and to stick with that consistently and not deliver volatility to the market. So
this is such a topical comment for the British political situation right now. I can't avoid commenting on it. But sorry.
Exactly.
Carry on.
But I mean, I think it's if you look across the insurers, the reinsurers, that we were looking at, Hanover very clearly stand out as one of the best performers over the last few years, and ultimately there's lots of reasons why that's the case. But one of the main reasons is that lack of volatility. They say to the analysts and the investors what they're going to receive, and typically luckily they stick to that. They're able to to provide that year after year. Actually, they often slightly they underestimate their expectations of the market and then over deliver. Again, that messaging has kind of reinforced the story of Hanover and how and how successful they've been. Clearly, they've got a unique capital management model. Clearly, there are other reasons why, but it's been one of the factors that's really driven that that market belief in them over the last few years. So I'd say those two things are really have been the drivers of the outperformance.
And I noticed some of the other sort of top performers that you had in your report highlighted. I think SCOR were up there as an example. Did it typically tend towards the largest players? Do you think size is a kind of fully necessary element in this, or did you see any smaller niche players able to buck that trend?
So I think size does matter, but it's certainly not the driving force, the driving factor. And some of the biggest players have performed actually relatively poorly over the last few years. I mean, it's really about that the underwriting, your underwriting gains. It's really about where you've chosen to put your dollar of capital across the market, and it's being able to reinforce that message clearly to investors as well. Size is a matter when you can deploy your capital properly. If you don't deploy your capital well, it doesn't really matter who you are. The outperformance is not going to be there. I think what size does do is sometimes provide a cushion. So there are some players that are able to continuously provide dividends to the market even when they're not performing well.
Yeah.
And I think that that is due to the size, the amount of capital they have to a certain degree. But I would say it's not a panacea. It's not guaranteed that the bigger you are, the better you're going to outperform.
Is that at the risk of labeling using the wrong consultancies concept that there's some absorption versus agility, I think, chart somewhere. But
it's interesting though, because you look at the need to pick risk better, right? Yeah. But to do so, you need to see the risk.
Yes.
And the bigger firms have a better opportunity to see all of the risks available to them and then be selective from there, where smaller firms sometimes don't have that ability. So size is a driver of the sort of inwards deal flow that you're interrogating, and you still need to pick correctly and price correctly, to be successful there. But there's absolutely a measure where it's like if you're a startup reinsurer trying to get on a slip, like the big deals, the really profitable deals are really hard to come by.
Absolutely.
When I was a broker, we had markets like desperate to get on the slips. And after 4 or 5 years of begging, they'd get like 0.1%. Like, even though it's great business, it's not something that they can sort of have full control over. Where, the bigger firms can be a bit choosier if they decide to be, and if they are.
I mean, it remains a highly concentrated market, and I think it's going to be very difficult to see how it won't continue to be a highly concentrated market going forward. I think your point on smaller reinsurers, I think, is really interesting. I think actually where for me more of the opportunity, maybe thinking about it almost from a third-party capital perspective, and where you're able to deploy capital in that respect into the market, as opposed to just being a pure play reinsurer with a traditional balance sheet and all the challenges that comes with. So I think going back to the question, size clearly matters, but I think the big players are able to use their size as a way of diversifying their risk across multiple lines of business, and as you said, to cherry pick that the risk from the top of the pie there. But even so, with that diversification comes challenges. You have to operationally be set up to be able to understand all those risks. You have to be able to get the data on all of those lines of business and have the internal operating model to be able to do the underwriting all the way through the underwriting journey in an efficient way. If you have multiple lines of business operating in different ways, you may well see great underwriting gains, but your operating costs are going to go through the roof. Yeah. So I think it's an interesting dynamic where bigger is better, but actually being better at a few kind of more concentrated lines of business may overall lead to a better outcome.
Yeah, it's an area we've not really touched on in the podcast so far, but this idea that we talk about the sort of diversity targets, what you're trying to do, and there's always this theory that if you diversify the portfolio, that will perform on the whole better. But you're right, there's a huge operational cost to do that, because you need to be able to have the underwriter and the expertise and the pricing abilities to do casualty, and now you want to do cyber. So that's a different team with a different expertise set. So it's actually, as you said, it's more operationally efficient to say we do property cat in North America really well, and just sort of stay in your lane there, and at least there's an efficiency of operational efficiency in that side.
And I think we're starting to see some of those dynamics coming through. We've seen over the last 12 months, quite a lot of players, for example, move out of Nat Cat and start to move into more specialty or other casualty lines. That's nice. That's fine on paper, and that makes sense. But you have to have the right underwriters. You have to have the right risk modeling capabilities. You have to have the right portfolio allocation capabilities as well, just to be able to support that business going forward. So, it's not as easy as saying we're just going to write all lines of business, or we're going to pivot from writing Nat Cat to writing other lines. You've really got to think through that journey and what that means for us operationally, and almost the dynamism of your operating model to be able to serve those different lines.
Absolutely, and I guess we should come on to this next topic in all sorts of ways, but specifically on the operational side of things. I guess inflation is going to play quite a big part as wages maybe feel a bit of pressure at these big firms that, as you say, are maintaining huge underwriting teams. It'd be interesting to see the extent to which those costs start to impact choices in that respect as well.
It is interesting. From what we've seen so far, I don't think we've seen a huge change in that respect. I don't think we're seeing that cost really coming through. Clearly inflation is having other effects on what you choose to underwrite from a risk appetite perspective. But that will change over time as well. I think there's also a huge amount of uncertainty about where inflation is going to go over the next 3 to 4 years. I don't think that's really being baked into core plans, core 3 to 5 year plans. But agree, it will definitely be a consideration when you're looking to rehire a new team at new market rates. It's going to be a very difficult discussion for, I think, a lot of the smaller reinsurers.
So I guess on that topic more generally, do you think the interest rates and inflation environment at the moment is going to double down on some of these trends we talked about, where maybe underwriting profit comes second and the the investment return is what trumps it, or will the hard market sort of counter that as well?
I think it's going to be very nuanced. It's going to be very nuanced by line of business and by geography to a certain degree. I think on the investment side, we've got this bit of a double-edged sword at the moment to a certain degree. So we've got a lot of these, some losses coming through for mark-to-market bonds and other areas, which are hitting insurers in the short term, reducing the amount of capital they have actually available to deploy now, which actually could be a fantastic opportunity right now to deploy capital in the right way. But just because of the way the models work and the way that the accounting measures work, that capital is not freely available given the value of the bonds right now. Over time, those bonds will mature and they will yield higher yields than they would have done, a year ago. So that will definitely come through, and there will definitely be higher investment gains there. I think on the underwriting side, it's so nuanced by line of business. I think clearly social inflation on the casualty side, it's a story that's been going for years. I don't think it's not a new topic, but it's clearly been exacerbated. And also to a certain degree, there's still the losses coming through from Ukraine. That's still a live event. People still aren't sure exactly what's going to happen there. So that still has to play through, to results to a certain degree. So I think if reinsurers were getting all of their returns from the investment side, I think there would be a problem. That's not really what the core of what reinsurance is about to a certain degree. It's not float business. It's not retail. It's not retail P&C. But I think that that will hopefully be a bit of a helpful boost for some of the firms when they're not going to see to a certain degree some of that hard market pricing come through across all their lines.
Yeah, absolutely. I'm waiting to see at some point whether the insurance and reinsurance academics can jump in for the next Nobel Prize contenders, following the interesting studies of Ben Bernanke and others around. What really is the role of the banking kind of sector? I'm curious to see whether we could put our own industry under a similar lens and think about some of these things at a more...
Because there is the broader sort of mitigation piece, like what is the function we're trying to serve, and a reimagining to some degree of what we're here to do, right? And this is the same thing that they did on the banking side. It's like, what is the target objective we're trying to serve to the sort of society as a whole? And I think it would warrant an interesting analysis as to the impact of the sort of risk protection space. Yeah.
I saw an interesting quote. I think it was yesterday from Mike Millett, so from Hudson Structured, and I think he was at a conference in Bermuda. And I think the sentiment came through is, if you look at it from a wholesale risk market perspective, reinsurers are not the whole of that market. They're a part of it. They shouldn't expect themselves to be the entirety of that wholesale risk market. There are other investors, capital coming in to support them. But I think to the question about what is the purpose of reinsurance in particular, as opposed to insurance, I think there has to be a reimagining. I think that, the way that the industry is today is, it's not sustainable. It's not sustainable to keep the same dynamics, keep the same mentality on pricing, keep the same mentality on underwriting that it has been for the last 5 or 10 years. I think we are going to see a structural change. Is there going to be a lot of introspection and rethinking what they're there to do? I think time will tell on that. But I think I think reinsurers may actually be forced down that route to a certain degree in order to really unlock where they're going to deliver value to their clients.
Are there any particular metrics? And no worries, when you haven't got the report in front of you, you don't know the exact numbers, but any metrics that you would sort of point to at the moment? I encourage industry executives to be looking at really carefully as they think about those potentially, identity changes in terms of what they are and who they are and what they do today.
So I'm going to do the typical politicians thing, mentioning Liz Truss, and slightly dodge the question, but I will still answer it, and if that's okay. So I think one of the piece of feedback we often get on the report is, okay, you take a very much an accounting view. You look at published results, and that's that's what you look at. And I think for me, it's really about taking a step back, purely from the internal economic capital view of the world. That is clearly very important, and that should clearly drive a lot of the internal decision making that you do. But I think it's about getting a wide variety of metrics and really understanding it from the view of the different stakeholders. So whether that's your internal economic capital view, your regulatory, whether it's Solvency II in Europe or Bermuda, other places, and your investor, the investor lens as well. I think for me that's that taking those perspectives, I think, are the important thing. It's very easy if you get sucked into a purely economic capital view of the world, that you make decisions that may look good internally, but don't look good externally, don't look good for your investors or others across the market. So I won't point to a particular metric, but I will say it's a variety of different metrics across a variety of different bases that need to be considered when making those decisions.
Do you have a perspective as to how long you think the hardening market period will last? Because the other thing that we've seen a bit, and it could happen again, is this process by which the conditions shift, and there's this existential moment people sort of begin to reevaluate what we might look like in the future. And if the conditions return to softening, everyone kind of gets a bit lazy again and goes, well, there's no urgency to do those things anymore. What is your thought of sort of how long this market sort of cycle will last, and then the impact of that downstream?
Again, it's going to be incredibly nuanced by line of business. So I'll take cyber as an example, just because that's where I spend a bit of time. So the hardening market on cyber has been definitely more extreme than other lines of business. I think the general expectation is that trend will continue to a certain degree, but that will have to stop at some point. I think there's only a certain amount the corporates will be able to absorb that. I think we're already hearing, for example, within the D&O space and other places, of slight softening of those market trends. So I think I think there's an expectation that those will slow down. For me, what's going to be more interesting is the divergence between the softening market from an insurance perspective and a reinsurance perspective, especially post-EN. So I think what we're possibly going to see is a lot of pressure on insurers to keep pricing down, especially because the market's been so hard. But then on the other side, the reinsurers are going to be putting pressure to increase prices, again, given the losses that have been sustained. So I don't think there's going to be a particular inflection point. I think it's going to be a couple of years of tussle between the different industry players, where prices can naturally flow through and where there is the appetite to absorb them. Insurers will have to retain more. Clients and corporates will have to retain more to a certain degree, and reinsurers will have to smartly put through pricing across where the lines of business they think they can. But I don't think there's going to be a natural point where it's going to go soft again. I think it's going to be much more varied by line of business. Again, given the divergence of dynamics we've seen across those lines of business and the losses we've seen over the last 4 or 5 years.
And in terms of, because I guess with all these interlinking different lines of business, with capital sort of constricting away from cat to some extent, especially in Florida, but in general, I think as people acknowledge climate change is something they don't necessarily want to play with. Do you think there is a willingness or even a resource available for them to reallocate that capital elsewhere, or is it just going to be a general shrinking almost of the activity of the industry?
It's a really good question. I wish I had a really quick, snappy answer to that one. I think it's a really hard and it's a really deep question. Look, ultimately, if reinsurers are going to continue to provide profitable growth that they need to for their various stakeholders, then there will have to be another route for that capital to go. What could happen, and I suppose where there's a risk, is you could just double down on the lines of business that you think are okay today.
Yeah,
I think that's a massive risk. I think if you continue to, clearly there needs to be some some sensibility of how you reduce the number of lines of business you have, but it's not about putting all your chips on one on one slot on the roulette wheel now. I think there's also a risk, and I think back to what you said of reinsurers that don't really understand some of the spaces they're getting into, really, doubling down where there's kind of hidden, underlying risks there. Sorry, I realize I haven't answered that question very well.
No, that's really helpful. And I think, I'd be interested to add another element to that as well when you commented earlier on things like share buybacks and other things you could do with that capital.
Yeah, I think you can. Again, it's a difficult dynamic to weigh up here, right? So share buybacks are seen very positively by the investor community, and there's lots of underlying fundamental analysis to show that has definite over time boost to your share price. But there is also an opportunity. Like now in particular, if there are going to be hardening spots across reinsurance, now is the time to a certain degree to think through where you want to place that capital. There is always will share buybacks increase? Almost definitely to a certain degree. But there's also, it's important not to lose that opportunity for longer term growth. I think one of the points in the report that we make is that if you look at it over the longer term, there are two things that really drive the value, which is the growth in tangible book value, so that profitable growth, and the capital distribution to the market as well. In the short term, actually, it's really that view of the multiple that drives growth. There's a bit of a divergent view between the 5 and the 10-year view here. So yes, it'll be positive signals in the market. The analysts will like it. You'll probably see a boost in the short term in your share price. But is that the right long-term value creation strategy for reinsurers now? I think that's the question they need to ask.
And I guess, and I wanted to give a bit of a scary element to this discussion, because we're lightheartedly chatting away about the sort of existential future of the industry. But it was striking to me when we take a step back out of reinsurance and insurance specifically to see, I think you have one exhibit in the report which shows insurance and reinsurance relative to all the other sort of 34 industries that you surveyed. And how did we get on?
So quick news flash, not very well. So I think, again, testing my memory here, I think reinsurance came 27th out of the 33 industries we had in that report. I don't think that's surprising. I think if you look at the space, well, first of all, I think insurance and reinsurance is probably seen, again, it's a bit of a broad brush generalization, as more of an income stock to a certain degree. So investors buy it for that dividend yield. I think it was also over the 5-year view. So that's when we've had the greatest challenges across the market as well. I think actually, if you fast forward 2 or 3 years and look back at some of the technology players, they probably won't be quite as strong as they appeared in that report. So I think it is a bit of a point in time to a certain degree. But even if you look back longer term, like if you're an investor, you really have to think, why am I putting my dollar of capital into insurance, and in particular into reinsurance? Now, I think the argument on correlation with other assets has been widely discussed, and I think that's clearly a good answer. But at the same time, you have to earn money. You have to be able to earn return on that dollar that you're putting into that particular stock. So we didn't do very well, but I think there's clearly lots of reasons why that's the case. But I think it's also a case of fundamentally rethinking where how do you make money in reinsurance, and how is that going to change over time. There's not going to be this big structural change in the industry, which means that reinsurers are going to go to the top of that pile. It's just not the nature of the business and the beast and the type of major risks that we take. But I do think the choices, the risk allocation choices, will change and will hopefully prompt a bit better growth over the next few years.
It's interesting, isn't it? And so thinking into that last comment you made, unlikely for us to, as an industry, suddenly leap in our ability to create value.
Yes.
Would you see that it is more likely that we could destroy value quite rapidly in certain scenarios, just given the nature of the game we play? Or
I think given the nature of the game we play, it's inevitable to a certain degree.
Yeah. Hopefully climbing in our value creation gradually, but occasionally.
Yeah, hopefully climbing. The reality of reinsurance is it's major loss driven. To a certain degree. That's the nature of the beast. So it's also especially if you look at the climate, the nat cat side, it's relatively uncontrollable. So it all comes down to the risks you choose, the price you're able to put through and how efficiently you're able to run your business. That's ultimately what drives that number there.
Yeah.
There's only a certain amount that the CEO of any reinsurer can control when it comes to climate side, and also it's a constrained space. The reinsurers are not the ultimate arbiters of that price. You've got the insurance players there, you've got the brokers in there. Each playing a different role in dictating what that market looks like. So they're not always masters of their own destinies to a certain degree. I think those are some of the reasons why it's never going to be the major outperformer. Could we get into top 50%? Hopefully, we can see that one, but it's not the type of industry that's going to get into the top quartile.
Sounds like snakes and ladders without the ladders, doesn't
it? Well, it's one of those industries similar to banking in some degrees where the market might almost reject the sort of us being at the very top of that list just by the very nature of the service that we provide and the products that we deliver, etc. So you wouldn't see the case where if there were no losses ever, like obviously people would either stop buying the products or your prices would come plummeting down. So it's designed in such a way that, as you said, it's a cash stock. It's intended to serve a purpose almost societally, right? And by that very nature, you're expecting it to sort of balance out into like we'll be in this sort of range amongst all these other sort of industries compared to like tech or compared to manufacturing or similar, which has unlimited upside in a number of different ways.
No, absolutely. And there's another interesting dynamic there across to carry on what you're saying across insurance and reinsurance, which is if you look at insurance, again, I'm talking broad generalizations here, but there's been a move away from very capital intensive lines of business towards capital light fee generating style business. And that has helped to manage a lot of the volatility within the insurance stocks. That is starting to happen across reinsurance as well. So perhaps one way you could leapfrog is, reinsurance becomes a capital light service industry to a certain degree, with more of a modeling focus. I think that's much harder. You've got a much more constrained view of, constrained set of clients if you're focusing on the insurance space. And also, as it's not the nature of what reinsurance is really there to do. It's really there, as you said, for that greater societal need to, as protection for large losses. So I think the dynamics would have to change, so much that it would dilute the very purpose of what reinsurance was there to provide.
Yeah, and I guess you end up with then a bunch of hedge fund type kind of models or similar, where maybe or pure fee income based models where you don't actually have much skin in the game, which could, to some extent mean you get less of the good stuff when you have good years. In exchange for relatively predictable portfolio and not being necessarily top of the list for clients as well.
Well, and we've talked about in earlier episodes the importance of relationships and things, and I think if when you look at a shift away from the existing model, a shift away from that very long-term client-centric relationship component, that will probably make it harder to get on the bigger deals, harder to get the really profitable business that client writes, because they're looking for partners who want to sort of support them across everything that they're trying to do from the insurer's perspective, right? So there's also, as we were talking, there's constraints as to the feasibility of them trying to do something different, because that behavior in and of itself might erode their ability to access deals that they might want.
Yeah, and also potentially erode the relationships they have with brokers if they're starting to step on each other's toes in terms of what they're doing. Erode the relationship they even have with the with the primary clients if they're offering services directly to the end customer, which the insurers are there to do. It's a delicate balancing act. So and if you look at the major reinsurers, there is to a certain degree a trend towards offering those capital light, almost service style solutions. It's yet to be fully tested. I think it's yet to be fully seen as a long-term growth vector for the reinsurance.
Yeah, we're looking at and speaking to insurers who are sort of building technology as well in pursuit of supporting clients, understanding their own portfolios and exposure analysis to various perils and things. Again, it's restricted to only the very largest reinsurers who could have the ability to build some of that out. But even then, in the way they market and present these solutions is with a very clear lens as to they don't want to step on the relationships that the brokers are having for their sort of risk mitigation services. And so everyone's trying to add value and find a way to make additional income through that. But with a very clear positioning of how does the whole value chain operate, and if I step on too many toes, I'm going to get my deal flow cut off or everything else. So it's an interesting dynamic that I think everyone is aware of and trying to build their propositions within.
If I was to say one thing that would wrap it up, I think the question that reinsurers have to ask themselves is, what are they good at? What are they fundamentally good at delivering to the market, and where can they really have a competitive advantage? That's really the question there. And it could be that within a narrow subset of that services or solutions business that they can have a competitive advantage. They have a model that is seen as market leading. They've got a way to distribute it. They've got a way to manage it going forward and monetize it. But it's not going to be end to end. You're unlikely to now find a reinsurer that can offer service and solutions across a huge variety of different lines of business, geographies, types of service, and maintain those profitably over time. So I think it's about saying, well, what are we, what fundamentally do we do really well? Are we great at underwriting? Hopefully, most of them will say yes, we're really good at underwriting. Yeah. Are we really great at underwriting a particular line of business? Again, hopefully, most reinsurers will be able to pinpoint where they're really good at. Do we think there's a market opportunity? Do we think that this is the right time to be investing in that space? And so how are we going to set ourselves up to succeed? How are we going to set ourselves up to be able to, to get the value that we need from that particular industry or line of business, and continue to be profitable, to profit ourselves? It's more of a it's a multi-dimensional problem, and I think that's where the reinsurers have to get to over the next few years, in particular because of the shift that we're seeing at the moment, in terms of pricing, in terms of major market losses, and this seems to be a bit of a moment in time where people are rethinking that dynamic and the paradigm of what reinsurers are really there to do.
I think that's an amazing spot to wrap up on, is this idea as we go into these sort of shifting market conditions, is looking at the way to survive is really digging into, like, what do you do well, and focusing their efforts there. The firms that do that very, very well and have clarity of that, I think will succeed. And firms that are sort of trying to manage that journey without any real vision or any real clarity to their path, I think will struggle. So unbelievably interesting.
Thank you so much,
Thank
Jacob.
you very much.
Yeah,
Thank you for having me.
Great to have you on the show.
Thank you.